I'm still busting for a shit.
That was Olivia. Rayleigh just did one. Okay. So we are up to looking at our contemporary issues. We are looking at 4. We are looking at credit, product certification, marketing innovations and technology. All 4 are in the syllabus, and they say that we must look at these contemporary issues. You have a large red box on page 71 to write down this one because it's a big one. Identify and investigate these contemporary issues involving the protection of consumers and evaluate the effectiveness of legal and non-legal responses to these issues.
This is our assessment task.
Kinda, yeah. Alright, so to start with, we are going to look at credit. So, credit. The issue of credit covers anything to do with consumers getting goods and services without paying at the time of purchase. Oops, I just haven't clicked the button. Click the button. Why is this a contemporary issue? Where are the injustices here? There's a dangerous combination here because credit is fairly easy to get and it can be difficult to pay back, and even middle class people, that is people making decent incomes, are increasingly feeling like they need credit just to keep up with modern life, thanks to marketing. Sydney Morning Herald put out an article, The Creeping Danger of Australian Households' Love Affair with Credit, back in 2015. You can get real goods and services with credit with someone else's money, and the money is often imaginary until you face the reality of having to make payments. Also, credit products are often marketed to vulnerable people. That is, people who are less likely to be able to pay them back. Okay, so let's look at the law. There is a single national law when it comes to credit called the Consumer Credit Protection Act of 2009.
Called the.
Oh, shit. That's not very nice.
I wrote the wrong word, so I'm mildly dyslexic.
Yeah, you haven't got your glasses. This law includes a code called the National Credit Code, the NCC.
Did you write the National Consumer Credit Protection?
All right, let's go get some liquid paper for Rayleigh. Back in a minute. Okay, so having the NCC gives us some advantages in that credit card obligations and liabilities are transparent. They're clearly spelled out to improve consumer confidence. Debtors know their contracts are backed by legislation and have freedom to organise fees and charges as long as these are explicitly disclosed, so no hidden fees and charges. Failure to comply with the code can lead to civil penalties of up to $500,000 and/or criminal charges. The code provides businesses with plain English guidelines. Credit agreements must be written contracts. Credit providers must ensure a consumer is given both a pre-contractual statement outlining fees and charges and information statement explaining the rights and obligations of the consumer. For the customers, the benefits are robust licensing schemes that excludes unscrupulous and incompetent credit providers. The credit card industry in Australia has greater integrity and consumer confidence. Rigorous conditions to obtain an Australian credit licence. All credit providers must meet reasonable standards, and credit card markets benefits from assurances that consumers are protected. Okay, let's look at the law. Plus financial services are also covered by Australian Consumer Law and the ASIC Act. The main enforcement agency for credit in Australia is ASIC, the Australian Securities and Investment Commission.
Okay, I'm in pain. I feel like I should go look now. What the heck?
Okay.
I just found out something. I didn't even know what. I'm guessing you missed it.
Okay, credit. The fact is, here in Australia, we have a single, fairly strict law for all of Australia, which is a good thing. By having a more regulated system than a lot of countries, we have more security when it comes to loans, credit cards, and rental agreements. There is more chance that people will be able to pay and less chance that the businesses will collapse like in the United States. If you ever want to have a good look at that, if you watch the film The Big Short, it kind of explains what happened with the loan situation in America and what led to the global financial crisis. Okay. The law, however, isn't popular with everyone. Credit providers like radio rentals have complained that other industries, like the telecommunications industry, are not covered by the law in the same way, even though they're basically providing services on credit and there are similar risks. Groups like the Consumer Law Action Centre complain that the penalties are not tough enough to deter bad behaviour. Banks make multi-billion-dollar multi-billion-dollar profits. A $1.7 million fine's not particularly going to hurt them. And everyone's looking at their phones.
No, I was looking at my finger.
Okay, ASIC enforcement remedies that they can do are punitive action, protective action, preservation action, corrective action, compensation action, negotiated resolutions, and infringement notices. For credit, the law wasn't always like this. There has been major law reform in the area since 2009. The changes have gone like this. 2009 to 2010, moved from state to Commonwealth law. There was the creation of a national crediting licence scheme. Credit providers have to be members of an approved external dispute resolution scheme rather than having issues go straight to court. In 2011 to 2012, one-page fact sheets were compulsory for loans and cards. When you go to the bank, you'll quite often see there's usually a big display of pamphlets that give you that kind of information. There was a ban on sending unsolicited credit cards. So here's your pre-approved credit card. Hooray, go shopping. For example, GE Money credit card dealing raises ASIC's IRA, the Australian 2013. GE were telling people we are going to increase your credit limit to X amount of dollars, and you weren't really given a say as to whether or not you wanted that to happen. There are requirements to warn about only paying the minimum payment. So if you buy something on credit and it says the minimum payment of $5 a week, but interest-free for 24 months. By paying the minimum payment of $5 per week or month, whatever it is, in general, you're not going to have paid off the balance. So when the interest-free period's up, you'll still owe money and then you'll start paying interest on top. So they really should warn you when you pay the minimum payment, it doesn't mean that you're going to pay it all off by the time that you want to, and a lot of people fall into that trap. Okay, in 2012 to 2013, the Consumer Credit Legislation Amendment Enhancements Act 2012, including regulations, made in 2012-13, put interest rate caps on short-term loans, making it easier to get a break using hardship procedures, and banned payday loans, although we've seen Wallet Wizard and Nimble still exist, so the ban hasn't really worked. The price cap, where they've put interest rate caps on short-term loans, the price cap is still 20% of the amount. Still, it's better than the 300 to 3,380% that it ended up getting up to before. Okay, we need to look at some of these credit issues in more details. Licensing, external dispute resolution schemes, unjust credit contracts, credit and the poor, credit histories, and all that fun. Okay, where are we? So first of all, we'll start looking at licensing. Businesses that provide credit or credit information have to be licensed. This is a good thing because it means if they don't fulfill their requirements, they lose that license. It also means that if you don't have a license, you cannot operate in the credit market, which includes leases. ASIC versus Make It Mine 2015, where they weren't licensed to provide credit when they started leasing, they got in trouble. Requirements of licensed credit providers include that they act efficiently, honestly and fairly, that they make sure its representatives are properly, make sure its representatives are properly trained, should be representatives. They need to be a member of an approved external dispute resolution scheme. What's this? Well, that's what we're covering now. Oh, pressing the wrong button. Okay. Oh, we're still writing? Okay. Pause. Okay. That was a good noise. What was that, Riley?
That was my silent scream. That was the kettle.
Okay. Up until 2018, credit providers had to pay to be part of an external dispute resolution scheme. I said screen before as well. They had some advantages in that they're free for consumers because these agencies are funded by the credit providers. Having individual cases resolved meant that few cases ended up going to court, which saves money and time for everyone. Oops, didn't mean to go that fast. Credit providers had a choice between a couple of external dispute resolution schemes, the two big ones being the Financial Ombudsman Service, the Credit and Investment Ombudsman, and each of these schemes had plenty of work and were pretty good. Through the FOS, 34,000 disputes were received. 61% of cases were resolved without even needing a hearing. Example through ADR. Any notes there?
No.
No. Oh, good. Okay, but this was a strange system. Why force credit providers to pay to be part of a system and then weirdly give them a choice about which one they were part of? So it was changed in from November 2018. All credit providers have to be part of the same place. Oops. That is the Australian Financial Complaints Authority. It will do the same thing as the previous three schemes, but the advantages of this one are that all complaints are handled in the same way instead of almost the same. There will be no confusion about who consumers need to complain to. And 3, the AFCA, the Australian Financial Complaints Authority's larger size will mean no resources will be wasted on duplication. The previous 3 bodies needed to have their own everything, so 3 people doing the exact same job in 3 different buildings. No notes?
Just highlight.
That's fine. We all highlighted up. Sweet. Okay, so unjust credit contracts, and I think I'll go through unjust credit contracts and then call it for today. So we won't finish all of credit today, but yeah. Okay, so unjust credit contracts, remedies. Under Section 77 of the NCC, if the court finds that it was unjust, it can order that an excessive charges be waived, that the interest rate be changed, and also that the contract be set aside or changed, and that the credit provider compensate the customer. An example here is, I can't say that word, Paseco versus ANZ, 2014. It was found that late payment fees were actually penalties, which is illegal because that's something only a court can do to people. The judge also decided that the fees were unconscionable. The real cost to ANZ was 50 cents. The fee that was charged was $35. Other charges were still legal though. Sydney Morning Herald article, ANZ late payment credit card fees illegal. Okay, but, okay. Guess what? In 2015 and finally in 2016 in the High Court, ANZ appealed and won. So it turns out that banks can charge a ridiculous fee for late payments, which seems quite unfair. It costs them 50 cents to do the paperwork to say you've paid something late and yet you were charged a $35 penalty. Okay. Another example, we have ASIC versus GE Finance. They were found to have made false or misleading representations. It is also against the law to send offers to people to increase their credit limits unless they ask. Really? Naughty girl. Unless they ask or consent, because it's way too tempting when a family's struggling with its bills to get an offer for more credit. GE told customers that they had to consent to receiving offers like this in order to activate their card, and for that they were fined $1.5 million in federal court. In ASIC versus the cash store, it was found that the cash store, who were a payday lender, gave out loans to lots of people on Centrelink while they were sure they couldn't pay them back, which then trapped them in debt. The federal court found that the cash store acted unconscionably and smashed them with $19 million in fines. And speaking of payday lenders, that's actually going to take us to our next part of the credit unit, which we will do tomorrow, credit and the poor. So we're almost, I think, nearly halfway-ish through looking at the contemporary issue of credit. See you tomorrow. Say bye.
Bye.
Wave.